Let me hit you with something that sounds illegal but isn't. You can pay your credit card on time. You can pay zero interest. You can do everything responsibly and still wake up to a 20 to 30 point credit score drop. Not because you missed a payment, not because of fraud, not because the system is broken, because you paid on the wrong day. That's it. Today, I'm going to show you exactly how credit card companies take a snapshot of your finances, why the due date is not the most important date on your calendar, and how moving a payment 48 hours earlier can instantly change how the algorithm sees you. This isn't about debt, it's about data timing. Most people think credit scores work in real time. You pay your balance today, so tomorrow the bureau sees zero. That's the assumption. Wrong. Your credit score is not a live stream, it's a photograph, and the bank chooses when that photo gets taken. If the picture gets snapped when your balance is high, that's what gets sent to the bureaus, even if you pay it off the next day. Let's break this down clearly. The billing cycle you've been ignoring. Every credit card runs on a cycle, usually about 30 days. Example, billing cycle runs from the 1st to the 30th. On the 30th, the statement closes, that balance gets generated, that balance gets reported to the credit bureaus, your due date might not be until the 20th of the next month. See the gap? The reporting happens before the due date. If you had a $3,000 balance on the 30th, that's what gets reported, even if you pay it off in full on the 10th. The bureaus don't care about the 10th, they care about the 30th, and that's where most people get blindsided. Why utilization hits so hard? Let's talk weight. In most commonly used scoring models, payment history is the biggest factor, around 35%. The second biggest? Amounts owed, roughly 30%. That category is dominated by credit utilization. Credit utilization equals current reported balance divided by total credit limit. If you have a $1,000 limit and report $500, you're at 50%. That's not neutral. That's risky in the algorithm's eyes. Here's how thresholds typically feel in scoring models. Under 30%, acceptable. Under 10%, strong. Around 1 to 5%, optimal zone. 50 plus, risk signal. Near 100, full panic. The system doesn't care that you plan to pay it off. It looks at what's reported at that moment. High reported balances statistically correlate with default risk, so your score adjusts instantly. This is math, not morality. Paying in full is not the same as reporting low. This part confuses people. You might be thinking, I always pay in full, so why does this matter? Because there are two timelines. 1, reporting timeline. 2, interest timeline. You can pay in full and avoid interest, but still report high utilization if you wait until the due date. That creates a psychological mismatch. Your bank account feels responsible. Your credit report looks stretched. That mismatch is what drops scores. The statement date strategy. Here's the adjustment. You don't wait for the bill. You manage the balance before the statement closes. 3 to 4 days before your statement closing date, you log in and pay down your balance. Not to zero, to very low. If you want optimal scoring behavior, aim for around 1 to 5% of your limit on one card and 0 on the others. Why not 0 everywhere? Because the scoring models reward active, responsible use. If you report 0 across all cards month after month, the system has no data showing how you manage debt. It can slightly suppress your score. This is where the all 0 except 1 concept comes in. If you have multiple cards, pay all but one down to 0 before statement close. On the remaining card, leave a very small balance. Let that small balance report. Pay it off fully by the due date. That's it. 2 payments instead of 1. That's the difference. Reporting versus carrying a balance. This distinction matters. Reporting a balance does not mean carrying debt or paying interest. Let's say your statement closes with $20. That $20 gets reported. Your due date is 20 days later. As long as you pay that $20 before the due date, you pay 0 interest. You are simply timing the data snapshot. That's the move.
Why scores drop so fast? Utilization is volatile. Unlike late payments, which stick around for years, utilization is memoryless in most widely used models. If you spike to 80% in January and drop to 5% in February, your score can rebound quickly. That's powerful. It means mistakes aren't permanent. It also means optimization works fast. You can change your utilization profile in one billing cycle. That's one of the few levers in personal finance that moves quickly. Where people mess this up? Autopay. Autopay is designed to protect you from being late. It is not designed to optimize your credit profile. If you wait for autopay to pay the statement balance on the due date, the high balance has already been reported. The optimization window already passed. If you want to control reporting, you need to know your statement closing date, not your due date. To find it, open an actual PDF statement, look for statement closing date or billing period ending, and mark it in your calendar. Set a reminder 2 to 3 days before that date. That is your action window. Step-by-step execution. Identify statement closing date. 3 days before it, check your current balance. Calculate 1 to 5% of your credit limit. Pay down everything above that amount. Let the statement close. Pay the remaining small balance by the due date. Done. 2 payments instead of 1. That's the difference. The trap: credit cycling. Now here's where people get reckless. They start paying down the card multiple times within a cycle to reuse the limit over and over. Example: $1,000 limit, spend $1,000, pay it off mid-cycle, spend another $1,000, pay again, repeat. On paper, you've pushed $3,000 through a $1,000 limit. To a bank's risk department, that can look abnormal. This is called credit cycling. While not illegal, heavy cycling can trigger reviews, freezes, or account closures because it increases perceived risk exposure. If you constantly need to pay mid-cycle just to keep spending, you likely need a credit limit increase. Higher limits naturally lower utilization. If you have a $20,000 limit, a $2,000 balance is just 10%, much easier to manage. Call and request increases periodically if your income supports it. Don't close old cards carelessly. Closing unused cards feels tidy. It can hurt you. Utilization is based on total available credit. If you close a $10,000 card with a zero balance, you remove $10,000 from your denominator. Your total debt stays the same. Your utilization percentage jumps. Keep old cards open when possible. Put a small recurring charge on them and set autopay. They act as padding for your utilization ratio. What about newer scoring models? Some newer versions consider trended data over longer periods. They may look at how consistently you carry balances. But most mortgage and auto lenders still rely heavily on snapshot-style scoring models. For now, statement timing still matters. Just understand that long-term behavior still counts. If you consistently live near your limit and only pay down before statements, newer models may see that pattern. Optimization is fine. Living on the edge isn't. When this actually matters. If you're applying for a mortgage, an auto loan, a business credit line, or a premium rewards card, then these fine adjustments matter. A 15 to 25-point swing can change your interest rate tier. That affects real dollars. If you're not applying for anything soon, staying under 10 to 20% utilization naturally is usually enough for strong scores. You don't need to micromanage each month. Use this lever strategically. Final protocol. Stop treating the due date as the only important date. Find your statement closing date. Keep utilization under 30% at minimum, under 10% for strong profiles. Before the statement cuts, pay down to a very small balance. Let that small balance report. Pay it off fully by the due date. That's it. The system runs on rules. Most people only learn the rules about late fees and interest. The reporting rules are just as powerful. Once you understand when the photo gets taken, you control how you appear in the picture. Try this on one card this month. Don't overcomplicate it. Just observe the difference. The algorithm isn't emotional. It's mathematical. And once you know how the snapshot works, you stop being surprised by score drops and start controlling them. See you in the next one.